what we're looking at is no one really has a great understanding what's going to happen this year, but there's a lot of themes that people can pick up on. And one of the themes that's great is revenue growth. And we're seeing that actually happen in Europe, because here in the United States, there's an earnings recession happening. As we're getting off of our easy monetary policy, you can see in Europe, they're actually stimulating through the ECB. So that's a great theme that you can play off of. But one of the strongest economies in Europe is Germany, and it's great because they are the exporter nation, right? I mean, they're 30% of GDP. So that's one of the reasons why we focus in on Germany, and we think DAX actually has, after last year, they were up about 10%. We think there's about 3 to 5% upside on a conservative basis, just because, as we alluded to earlier, you know, they're export oriented. The German consumer is doing very well. But one of the key cogs that will help this investment thesis is valuation. So if you look at the DAX is trading at a 12 PE, right, compared to the United States, which is still relatively elevated at about a 16% PE, and earnings are coming down, as well as it's giving about a 3.5% dividend when the U.S. is trading under 2%.
But do you think these dividend payouts are going to continue, and especially when looking with an eye towards the energy sector?
Yeah, and that's a great question, and that's why you've got to pick and choose when you're in Europe, right? So if you start to look at the DAX index, it has lower exposure to energy. But when you go over to the FTSE 100, right, I mean, it's pretty heavily weighted towards the energy sector with Royal Dutch Shell, BP. So if you think there is going to be a rebound in energy, you can go to the FTSE 100, which is actually spitting off about a 4.2.
And the divergence between what the Fed is doing and the ECB, are we moving closer to each other now, given the global turmoil that the Fed might not be able to hike? So the difference in expected performances in U.S. equity markets versus Europe might not be that much of a contrast.
Well, what you're going to see contrast-wise is that the the economy is doing very well here, and growth is going to decelerate, right? We're still going to grow, but you're going to see better growth happening in the Eurozone, and that's better for Europe multinationals, especially those ones denominated in euros, and that's why we think there could be outperformance in European equities, especially the multinationals, because they do have the strength of the weaker euro to pick up more sales in the Eurozone, as well as against their American counterparts in China. So we know China is slowing down. Are they growing at 6%, 5%? We don't know, but European equities are set to benefit more from that. And one of the ways to look at that is look at the autos in Europe, right? I mean, you can see they're actually trading for the first time that I've seen in a long time at a higher multiple and premium than their U.S. counterparts. So that's really telling. So I think one of the things that's going to happen is global growth is set to be sub 2%. That's why you want to stick to the large multi-cap national names.